syllabus. Yeah. Just gonna, everybody has the resume templates. So you know how to do it. Don't have a resume, you got some Mary Beth. Okay, here are the templates. We need an extra. Yeah. They're also up on the website too. Okay, so you're going to need to hand in your resumes for the quiz, the midterm, and the final. I will probably give those resumes to Mary Beth too at the end of the semester to actively try to find you internships and jobs if you want one. If you don't, we'll still probably try to find them for you. Okay? And if you don't, you tell your parents. You're spending all that money to send you here and you're not looking for a job. No, I'm kidding. And then anybody interested in double concentrating in data analytics? Okay. Mary Code does a really good job of basically framing up a bunch of courses for you, double and triple counting some of that stuff so that you can not take, courses, types of courses, but you can actually double concentrate in 2 concentration areas to then improve the probability you're going to get an awesome job once you get out of here. Data analytics is probably the hottest double concentration, but you're going to need the calculus. Once you get the calculus, it's only like three or four more courses. And if you had a choice, I would do marketing and finance. If I was accounting, I'd do accounting and data analytics. I would do anything with finance and anything with data analytics in combination with your concentration, and that way that you can go both sides. Okay, you'll be in really, really, really good shape. Okay, I'm going to hand this around. Okay, sign up, come see me. Okay, pretty specific time periods to come see me. You all should come see me. Okay, you should all come see me. Usually my best students come see me at least multiple times during the semester. The students that don't come see me usually don't do as well in the class because they don't know how to interact with managing directors. They look at me as a professor and not as a professional advisor or professional. So it's like this weird psychology. Once you get over that, you start working with me, you can talk to other people about me, I'm totally committed, and I will totally help you out. Okay. I also sent out this morning the extra problem set. Okay, and the solutions are also posted to the website. So that's all you got to do. You work through the problems, you have the solutions, you transfer over, so you're just practicing the solution. I kind of look at, when you get out there in the real world, you don't have time to sit there and be aggravated, over solving problems. It's like, give me the solution, I'll test it, I'll figure it out, but give me the answer, and so I can figure it out. Okay, so you can learn and end up learning more, I believe, this way than sitting there frustrated trying to solve a problem that you're stuck on for 2 hours when you could have gone through maybe 10, 15, 20 questions within that 2 hour period. So it doesn't make sense to me. You can make an attempt at it, then check your answer. That's awesome too. Or you just look at the problem, look at the answer, transfer it over, and practice going through these problems. And then I'll give you extra credit. Okay. And then if you have any more of these, I'll take them. These surveys. Let's do, let's see, is there any of these hanging around? Do you see any of these notes? Any more of these? There you go. I think I have enough of those. I don't have enough time to come to class because there's another class before me. So I can't go up on the board and write things out, so what I did, sorry, what was your name again?
Noah.
Noah, what I did was I sat down this morning for like an hour and wrote out some notes on basically the expectations for the next couple of days. Okay, does that work for you?
Yeah, that'd be helpful.
Okay, awesome. And then on Thursday, we're gonna have Team 2, Chapter 3.
Yep.
Perfect. And then we're gonna have Team 4 and 5. Chapters 4 and 5. Okay, so make sure you look at those. I already provided you with the solutions to the homework problems, so you can embed them into the PowerPoint presentation. You can work through the problems as you're making the presentation. How's that? and really focus on the future values and the present value chapter. Okay, that's the heart and soul of it. We're going to be doing all that stuff. Okay, let's spend a little time. What we're going to do today is I'm going to spend a little bit more time on the statistical pretest. Okay, and then what I'm going to do is I'm going to start working on the exam. Okay, does everybody have the statistical pretest and have the exam? And do you have your blue book to write the notes about the exam in the blue book to use as a study guide and extra credit when you hand in the blue book during the quiz, for the quiz? Yes? No? Yes? No? Yes? Yes? Perfect. Thank you. Okay. So we'll do that. Before I get started, can we do a quick market update? Quick market update. Where's the Dow right now?
Dow is at 25,958.37.
And then any news on what's driving the market down? Is it trade? Is it Trump? Is it interest rates, inflation? Yeah, exactly. Anything? Earnings expectations, interest rates?
Not particularly.
You know, maybe a continued sell-off and just some instability. I know the trade negotiations is a big deal right now, creating volatility in the stock market. Where's oil prices? I checked them this morning.
Crude oil at 70.04.
How much?
70.04.
78? 79?
It says 70 for me.
What is it? 70.98?
Mine,
69.8, so it actually was about $70, which is a psychological level. It looks like it's dropped down below that. Okay, so the question is what it is. I know there was a lot of issues.
there was a mention that basically markets are preparing for 1 million barrels of oil for, right here.
Okay, so basically oil prices are off their peak right now. I read this morning that they were concerned about unrest in Iraq, Iran's sanctions. There was still some bombings in Yemen and the south of Saudi Arabia. Some potential political instability in the Straits of Hormuz. Venezuela has basically stopped producing, and Russia's is in a recession too. So those are all geopolitical events that can impact oil prices. Where's gold today for us? Where's gold trading?
Gold
Remember, you're a trader now.
Gold is 1197.
What is it?
11,000.
Oh, so
1,197.47.
gold prices have actually dropped below the psychological 1,200 an ounce currently. That's either deflationary, or you'd think if there was more political unrest, people would be buying gold as a store of value and a precautionary measure. The gold prices are down, so either they're selling off gold and buying stocks. You said the stock market was up,
Yep, I think it's
or was it down?
down.
Down?
Yeah, sorry.
So gold prices are down, stock prices are down, so bond prices must be up. If they're selling off gold and selling off stocks, they're buying
Yes.
bonds.
10-year
So did the
bonds are-
10-year treasury yield drop below 2.88?
10-year bonds turned into
2.9?
2.9.
So has it gone up or down?
It's gone up.
It's gone up, okay. So basically, they're selling off bonds, driving up interest rates. So we got a sell-off in the gold market, sell-off in the stock market, we got a sell-off in the oil market, and we got a sell-off in the bond market. Something's going on, because that usually doesn't happen. So something's going on. What's happened to the dollar and the pound and the dollar to the euro? Is it costing us more or less than yesterday to buy a pound or a euro? Costing us less. So the dollar's appreciated and the foreign currencies have depreciated, right? Because it's cheaper for us to buy their currencies now. So we've appreciated, they've depreciated. So there's probably continued capital flight into the United States, driving up the dollar because of political instability and global meltdown in the emerging markets. The emerging market currencies are imploding. Argentina, Greece, Brazil, Mexico, there's something going on. The question will be that be the contagion of the trigger event that could trigger a crisis of some sort or potential recession? But people are precautionary right now. They're selling off their foreign assets and they're moving into the dollar, driving up the dollar, depreciating it. Okay. But now we're seeing, but you would think they would buy the dollar, cause the dollar to appreciate, and then buy the bonds, which would cause bond prices to go up and interest rates to go down. Right? But bond prices went, did the yield go down or up? yield went up, so they're selling off the bonds too. So this is kind of a weird, we're in a weird place. It'll be interesting to see what happens. So there's a lot of geopolitical events, economic things going on globally that's causing some of the trading theories to be counterintuitive. Okay, so you should be reading and monitoring all of these things all the time. Okay, you can get apps on your phone, be delivered news. So you should be, every day when you wake up, check the stock market, check oil, check gold, check bond yields, check currencies. Okay, and start following the markets. All right, let's do the memo. Will you pull that out for me? Did we go over this once? The memo? And there's a video too on the course website. But I'm going to go over the memo today. I'm going to keep going over it until we totally get it. So my strategy around the memo would be to replicate the first memo exactly in regards to the format. Okay? And then I'll make some corrections. There are some errors in this memo. Okay? So the first thing is at the top, you're going to have capitalizations, memo in caps, bolded in 16 point. I think that's 16 point. Okay? Then off to the side here, you're going to have date. You're going to indent, okay, and then put in the date. You're going to double space. You're going to say 2 semicolon indent, and then put my name in there. Double space from semicolon indent, then your name. Double space RE in caps, semicolon, and then this is how it works. The language in this memo is perfect, okay, pretty much perfect. So the only thing that really needs to change in this, once you set it up, is the numbers change and maybe the direction, so it's very logical, okay? But do you think that when you go work for somebody in a company that they are going to have standardized memos, standardized reports, and standardized presentations? They will have standards. Or they'll say, oh, you know, just go do a memo for me. Or just write me a report and give it to me. Or go do a presentation and get in front of the client and just make the presentation. Or are they going to say, here's the templates that you are going to use to build the memos, to build the reports, and build the presentations, because that's the templates that we use for all of our memos, reports, and presentations. That's what they're going to do. So this is the template, okay? This is the standard. This is a standard executive memo, an executive brief, a trading brief, a client memo, an executive board brief memo. It's the exact same format, okay? Looks exactly the same. This is a trading brief. This is a trading brief that you would submit to me as the managing director of the trading division at Morgan Stanley. It's 5 o'clock in the morning. We meet every Monday, Wednesday, Friday. You bring me these memos, or you give them to me before we meet. I review about 50 of these things very quickly because I can go through them very quickly because they're all the same standard. And then I basically walk in to the meeting and I said, here are the ones that I want to hear about, that I think I'm going to give you the $25 million to trade on. And then here are the ones that there's some logic here, or I think there may be some more research that needs to be done. I really didn't understand what you were getting at. These are the ones we'll need to work on, okay? And you're the managing director. You get paid probably $300,000, $400,000, maybe $500,000 a year. You have 2 analysts that you're paying $150,000, maybe $200,000 a year. You can get a bonus of $1 million if you trades, and your trade recommendations are correct from a trading standpoint. And if you're managing the portfolios and you can exceed the return performances, or you can hedge off the risk using these derivatives, we're going to give you the bonuses too, because you basically, you know, preserved wealth, you created wealth, and you're giving value to the firm, you're giving value to the clients, you're giving value to your division that you're managing. Okay, that's the way it's going to work. So here's the stock memo. Stock prices forecast to rise 5% over the next 3 months. Over, the O and the over should be capitalized. So you should make these corrections now. Okay, there's a space after that line, and there's a space before the next paragraph. We are tracking stock prices. Do we know what we're tracking? Within the first sentence, do we know what we're tracking? Stock prices, right off the bat. Based on our research, we forecast stock prices to rise 5% over the next 3 months based on the following factors. Do we know what direction the stock prices are gonna go? Are they gonna go up or down? Up by how much? Over what period of time? Exactly, now you're an analyst. Okay. Now you're an analyst. Okay. Based on the following factors, semicolon, gains in Dow Jones Industrial Average, S&P 500, and NASDAQ. Personally, gains, the G, I would not capitalize. And I wouldn't say gains, I would say upward price momentum. To be technical, in Dow Jones, S&P 500, and NASDAQ. And then I wouldn't use a comma, because you have 2 commas before that. I would use a semicolon. Right? Am I wrong in that? People who got A's in their grammar classes, is that right? I would use a semicolon.
Where exactly was that?
It's upward price momentum in DJIA, S&P 500, and NASDAQ. And after the Q, I would do a semicolon. Then I would say wage growth. I wouldn't capitalize the W or the G. I would do another semicolon. And I would say low inflation, because inflation is a growth rate. So you don't need growth, it's redundant. So take out the growth. Period. Therefore, we recommend the following 36 trades. There will always be 36 trades. Okay. In the table, there's only 2 sets of trades based on your forecasts. Okay. Yes.
You still want it all in bold, those same like words in bold?
Yeah.
Same words numbers?
Yeah, because that's really what I focus on, right? It's going to be, well, was she forecasting stock prices to go up or down by how much over what period of time? Well, now that I know the direction, I can check your trades, your trade recommendations. This memo is all integrated, okay? And that's why it's such an awesome memo. It's not just a blah, blah, blah memo. It all integrates together and basically communicates extreme competency on your part to the reader, okay, that's reading this. And it could be a client or an managing director or a senior level person or a board member. Okay, and low inflation. Therefore, we recommend the following 36 trades, we are tracking and trading off of 3 indices or indexes, 3 stock indices or indexes. Indexes is less appropriate, indices are more appropriate for the terminology. We basically have 4 trades, 3 indexes and 4 trades for a total of 12 trades off of the indexes. Since we're forecasting the prices to go up for the indexes, and I'll go through these a little bit later and explain exactly what they are, but you only have to memorize 2 sets of trades. When prices go up and when prices go down. When prices go up, when you're trading the indexes, and the indexes are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. If prices are going up, you're going to buy forward contracts or forwards, buy futures, buy calls on futures, and write puts on futures. 3 indices, 4 trades, 12 total trades. Got it. We are also tracking 3 exchange traded funds, or ETFs. The ETFs are actually shares in a portfolio that mimic the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. So you could go and Google Dow Jones Industrial Average exchange traded funds. And you'll get Fidelity, Schwab, JP Morgan. You'll get a bunch of companies that basically have listed their exchange traded funds on the New York Stock Exchange. And those shares, based on the portfolio composition, is trading like a stock on the exchange. Okay? And since we think prices are going up, I'm not going to just buy those exchange traded fund shares. I want to leverage. So what I'm going to do is I'm going to buy these shares on margin, which means that I'm going to put in $100,000 and I'm going to borrow from the brokerage firm another $100,000 and pay them 9% on the money. And I'm going to take that extra $100,000 and I'm going to buy $200,000 worth of exchange traded funds instead of $100,000 of exchange traded funds. And if I'm right, my return on equity goes through the roof. If I'm wrong, my return on equity goes through the floor. That's the power of leverage. If you're right, which you guys are going to be most of the time because you're really smart and you know the economics and the finance and the quant, that you're gonna be able to benefit from these types of trades. Okay? You're also, as prices are going up, you're gonna buy calls and you're gonna write puts. Okay? And the trades for the exchange traded funds are exactly the same as the stock trades. Okay? So I'm trading 3 ETFs, 3 trades, that's a total of 9 trades for the ETFs. And I'm also tracking and trading 5 stocks. And what I did was I took the top 5 stocks. I could have taken the top 5 stocks in the Dow Jones Industrial Average, the S&P 500, or the NASDAQ, or I could have found 5 stocks, I don't care who they are, and you put the tickers right there. So I'm trading 5 stocks, 3 trades, for a total of 15 trades. 15 stock trades, 9 ETF trades, 12 indice trades, for a total of 36 trades. So I can go to our proprietary trading unit, our traders in our company, and say, here are the recommended 36 trades that I think you can profit from once you've tested them. These are our recommendations from our division. Or I can go to my clients and I can say, we've done the research, here's the memo, here's our 36 stock trade, ETF, index trade recommendations that we recommend. And we recommend that you buy on margin or you do these derivative trades, because the derivatives allow you to take your 10 million bucks or your $1 million that you were going to invest in here and take it to 10, so I can leverage it. If I use the derivatives, I can take $1 million and control $10 million worth of stocks through derivatives. So that's the power of leverage. Okay. Then, here you have basically the technical and the fundamental securities analysis around the indices and the ETF and one of your stocks, and you talk about where's the index level. It went from X, since January 2018, the Dow Jones Industrial Average rose from 2, up X%. Now you're an analyst. Okay, now you're an analyst. So by putting index levels and percentage changes over periods of time, or prices, or ETF levels in here, now you're an analyst. Okay? And you're all going to be doing analyst work, all of you. Okay? They're going to ask you to write reports. They're going to ask you to analyze stuff. They're going to ask you to write it up. Okay? And tell us what happened. Okay? Based on some trend over time, benchmarking and something else. Okay? So as soon as you start getting comfortable being an analyst, you got to be an analyst as quickly as possible. And then the 2 graphs right here is the technical analysis. So this could be a chart of one of the 3 indexes, or the 3 exchange traded funds, or the 5 stocks, going back at least 3 years. Okay? Because I'm going to teach you later on the technical analysis. Because when you're valuing stocks and trading stocks, you're going to use the 4 valuation methodologies. When you're trading stocks, you're also going to be using technical analysis, looking at price patterns of these indexes. Okay? And we benchmark ourselves off of these indices and these exchange traded funds. And if you're a company, you're probably benchmarking your stock performance if you're publicly traded off the S&P 500. And you'll be doing that in everything you do. This is just financial benchmarking. When you go work for somebody, if you're looking at inventory control systems and trends and purchasing and production, you're probably going to be benchmarking off some external or some internal benchmark. So benchmarking is key. Okay. So any questions on that? So if you're forecasting the prices to go up, these are the trades. If you're forecasting the prices to go down, you go to the gold prices and use those sets of trades when you pick the prices. So those 2 sets of trades you need to memorize. When the prices go up and when the prices go down. Okay. Any questions? And then I would watch the videos, and I'll go through this in more detail. Is anybody interested, little sidebar, anybody interested in taking the SIE exam? I highly recommend, Elizabeth obviously is going to take it. You need to take this. Anybody who's a marketing person who wants to work for Schwab or JP Morgan or Goldman Sachs or Wells Fargo or B of A, or BlackRock, which is an awesome place to go work in the marketing department. If you walk in with this, you're almost guaranteed a job, okay? Because nobody else will have this, okay? This is the first half exam of the Series 7. You pass this, that shows you have interest and you have competency, and you can walk in. You have to have a Series 7. In most cases, I did. When I worked for Schwab in their marketing department, I had to have a Series 7 to present the material and to write it and produce it. I had to have a license. I wanted to be a chief of staff, running a marketing team at Goldman Sachs, I gotta have a Series 7. Okay. So sometimes you need these licenses just to get into management or marketing or ops or whatever. Sometimes, and it sends them a very strong signal. And that'll send you into banking, private equity, investment banking, brokerage, real estate securities, debt securities. It opens up huge options for you to be able to get opportunities for yourself. Okay. And it doesn't really matter where you start, okay, in your career. It doesn't really matter where you start. It's that you start, okay. And if you can start on a really good foot, your trajectory is going to be so much further, faster, and you can just leverage your position, okay? And that's the goal. All right, so let's do the, how much time do I have? I need an hour.
Around an hour.
Perfect, okay, so I'm gonna spend 10 minutes or 15 minutes on the pre-test, even though we did it. I worked through some of the pre-tests in the last class, so we can focus on it. And then we'll go right into the exam. Okay, so you gotta have to do that. So I'm gonna burn through this, since we already went through this, right at the end of the last class. We already understand the value of all those numbers. We understand the arithmetic mean is just the average, but again, you're subjected to outliers. So that's why we use geometric means in those cases. You're gonna be dealing with different types of distributions in the data sets. So what you have to do is some data analysis to look at the distributions to see if they're binomial or exponential or skewed or Poisson. So once you know what the data distributions look like based on your data sets, you can apply the statistical applications to get the information you need to be able to make decisive business decisions. Or you have to go back and you have to transform the data, either through some kind of data transformation or some kind of filtering process to get the distribution to a point where you can then apply the statistics to get the information to make the decisions and make the policy recommendations to who you're talking to. They're going to expect you to know that process. So show me the definition, show me the value. Mean, median, modes. Mean, show me the equation. It's subjected to outliers. So you're going to have to, in a lot of cases, filter the data and then get rid of the outliers and then recalculate the mean. The median is high to low, pick the midpoint. Got it? And show me a median situation where you rank from high to low and then circle the midpoint. And then the same thing with the mode. Show me a series of numbers. The one that reoccurs the most, that's the mode. Okay? And then skewness means that the distribution skews from one side to the other. You're going to have to, if it's skewed, you're going to have to do some filtering process or some data manipulation to get it normal, to apply mean variance analysis, because all social sciences, we're not in the sciences, we're in the social sciences. All social sciences assume mean variance. That's what finance, accounting, ops, data analytics, it all assumes some kind of normality within the data, and you're comfortable, your ability to be able to transform the data, okay? Kurtosis is the peakiness of the distribution, and the kurtic is you have a fat tail and a skewed distribution, it's the worst of both, okay? And that was the financial crisis. Histograms, stem lead, box plots are just data analysis tools to be able to look at your distributions very quickly, to be able to decide what you're going to do with the data and how you're going to correct for it. So it's a data visualization. Variance, standard deviation is the measure of dispersion, and it is a measure of risk. So whenever you hear standard deviation or variance, dispersion and risk should go through your head. Confidence intervals basically sets the interval around the mean within the two standard deviations of using data. Confidence levels, 99, 95, and 90. I've been writing all this stuff. In social sciences, we use the 95 and 90 confidence level. And in sciences, or when we have really big data sets, we'll use a 99 level to calculate the T statistic to try to test for statistical significance of the independent variable. Z statistic is what you use. It's called student T when you have small data samples, but usually we have large enough samples, so we're going to use the T statistic and the F statistic. The T statistic usually ranges between +2 and -2. So if it's +2, it means that the data time series is highly correlated, positively correlated with each other. If it's negative or -2, it means it's moving in the opposite direction. You will never see the T stat, a perfect ±2 is probably going to be somewhere in between if it's a good model. Okay, we're usually looking for T's around 1 or 1.25 as a benchmark. The F statistic, when you're measuring the statistical significance of the full regression model to predict the dependent variable, it's the F statistic that measures the model's capability to predict the dependent variable. And the F statistic, if I got a 5, I'd be pretty happy. If I got an 8, I'd go, this is almost too good to be true. And if I got a 13, it would be too good to be true. So if I'm getting F statistics of 13, I probably have multicollinearity, which means that there's variables in my model that are highly correlated to each other and the dependent variable, and I'm going to have to get rid of 1 or 2 of them, okay, to reduce the model down. And I'll explain that in a minute. The coefficient of variation is the standard deviation divided by the expected return. So it's the risk to return ratio. Okay? The inverse of that is the risk-adjusted rate of return, which is the expected return divided by the standard deviation. So the expected return divided by the standard deviation gives you the unit of return per unit of risk. Unit of return per unit of risk. So let's say I have 3 portfolios. They're all 3 of them are returning 10%, except that portfolio A has a standard deviation of 10%. Portfolio B has a standard deviation of 5%, and portfolio C has a portfolio standard deviation of 2%. So my return to risk ratio for portfolio C is 5. The return to risk ratio for portfolio B is 2. The return to risk ratio for portfolio A is 1. Which one would I pick? A, B, or C? Would I pick the one that's giving me 5 units of return per unit of risk, 2 units of return per unit of risk, or 1 unit of return per unit of risk? 5, exactly, so I pick C. Got it. Now you're a portfolio manager. Okay, that's what we do in portfolio construction, and that's what we do in portfolio selection for our clients. Okay, and we run that. All right, got that. Covariance. Covariance, if you look at the covariance equation, it's basically you're multiplying the dispersion between the 2 stock returns together. Okay? That's what you're doing with the covariance, and then you're dividing it by, in this case, if you have 2 stocks, by 2. So it's basically the average dispersion between the 2. Okay? It's the average dispersion between the 2 combined together. And then the correlation coefficient is that dispersion for the 2 stock returns divided by the 2 stocks standard deviations. So it's the dispersion divided by the 2 standard deviations multiplied together. When you take the dispersion or any numerator and divide it by a standard deviation, you're normalizing it. You're normalizing it. That's why the correlation coefficient ranges between +1 and -1. Because you're using the standard deviation to fit it and cram it in between +1 and -1. Okay? And if the correlation coefficient is +1 or 100%, it means that the stock or stocks in your portfolio are moving exactly together, and you're not getting any diversification whatsoever. But if you add stocks to your portfolio whose returns have low correlation, no correlation or negative correlation with each other, you're getting diversification. Okay? In most portfolios that I build for my clients, they want diversification. They want an 8 to 10% rate of return, and they want diversification between stocks with low, no, or negative correlation with their returns. Now I got diversification. And if I can give my clients 8 to 10% rate of return, they're happy. That's it. Okay? If you can do that, you win. Money will come in. In the portfolio standard deviation equation, either can have the covariance on the end or the correlation on the end. Okay? And if the covariance goes up, the portfolio standard deviation goes up. If the covariance goes down, the portfolio standard deviation goes down. If the correlation goes up, standard deviation goes up. Correlation goes down, standard deviation goes down. Covariance goes up, standard deviation goes up. Covariance goes down, portfolio standard deviation goes down. So it's positive. There's a positive relationship between they move together. Okay, so that's really important to know. What is the value of using regression techniques? Here's the regression model right here. Here's my dependent variable. My hat equals the alpha, the intercept, plus beta hat 1 times the first independent variable, plus beta hat 2 times the second variable, beta hat 3 times blah, 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 all the way out, plus the error term hat. Okay? These hats, where the error terms, the beta coefficients, are the estimates. Okay, are estimates. So the goal in this equation is to minimize the error term, the mean squared error. Okay? And this is the way it usually looks. So I got a bunch of data sets, I run the regression, it fits the regression line through the data set. The alpha is calculated here. Here's the simple linear regression model. This is the beta coefficient of the slope of the line. Okay. Got it. Then these are the individual data points. The difference between the data point and the regression line is the error. This is the error terms. How well did the regression line fit the data? Okay. The bigger the error, the bigger the dispersion, and the lower the capability of the model to do prediction. Okay. So those are that's the model, that's what I want to see on the exam. That's what I look for. It's the first thing I look for in the pretest and on the exam. Do you know the actual theoretical model structure for a regression equation? Because I'm trying to burn the stuff into your brain. So it flashes in front of you when somebody asks you this stuff in an applied setting once you get out of here. The cross-sectional regression analysis, I work with a lot of startup companies. They haven't been around a long time. So we don't have 15 years of quarterly data going back in time. We only have maybe 4 quarters of data. So I don't have enough data to do a time series regression analysis to try to forecast sales or returns or profitability or whatever it is we're trying to forecast. So what I do is I find companies just like ours, same size, same industry sector, where I have data, and what I do is I basically list the companies and put the data set in here for those companies. So it's one period of time, multiple variables, multiple firms. So the firms are the data sets. They are the data elements. And then when my firm gets older and has been around longer, then what I can do is take the same variables, put in the time series data, and then rerun the regression. But this is the beauty of moving from cross-section to time series. I might not have a lot of time series data, but I have a lot of firm level data. So I can rerun the regression, I can come up with coefficients, and then my company, us internally, will basically forecast what we think these variables are going to do over the next 8 quarters, pump it through the model, and we can forecast sales, production, returns, those things. So going from cross-section to time series is great. Are you guys following along back there? Okay, cool. All right. So I'm looking forward to test the significance of the independent variables. I use the T statistics. To test the model significance, I'm using the F statistic. or the adjusted R square. Okay. So it's the correlation of the variables within the model to predict the dependent variable. You're probably going to be asked to build a model. Somebody asks you to build a forecast model, what's the first thing that comes out of your mouth? Yes. Okay, got it. Depending on who your client is, or who you're working for, they may or may not know what they need to be forecasting. Okay, is it profitability? Is it production? Is it revenue? Is it earnings? Is it what is it that they're trying to forecast? So you, as the expert, may need to guide them on picking the metric that they need to be focused on for profitability or survival, whatever it is. The independent variables are going to come from the people that you work around, because a lot of them are going to be experts. So you're going to ask them, what independent variables do you think drive sales for semiconductor chip sales on a global basis? So you ask people internally. And then you may have colleagues outside the company, and you're working on this project and you're being a little innocuous because you might have a non-disclosure agreement or NDA that you signed, so you can't disclose what you're doing. But it's like, hey, I was thinking the other day, what drives semiconductor sales on a global basis? And what would be those factors over the next, 8 quarters? And then experts around you can give you some inputs. And then what you're going to do is you're going to go to the library and you're going to read peer-reviewed journal articles. Excuse me, hold on a second, because it's distracting. You're going to go to the library and you're going to research in peer-reviewed journal articles that have been written by academics or industry on forecasts for semiconductor chips on a global basis. And they're going to tell you what the variables should be also. So between people internally, around you, externally, and from the literature, you're going to be able to narrow and build a model that will do a really good job of forecasting what you're trying to forecast. And if you can forecast accurately, you're going to do the presentation, you're going to make the recommendation, you're going to probably get the bonus and the promotion, and you're probably going to head up, elevate yourself within the firm if you can build these models and be accurate in doing it. How would you select and determine these variables? The dependent variable, either you make the recommendation or somebody's going to tell you what they want. The independent variables, you got to ask them right off the bat, or you got to go out and do the research and look at other research that has been done that built the literature and built the theory behind it. What are the tests of variable and model significance? The T and the F are the adjusted R square. What is the problem of multicollinearity? I have 2 variables in my model that are highly correlated to each other and correlated to the dependent variable. I can't have them in the model because it's messing up the model. It's messing up my T statistic. It's making my adjusted R square look too good, and it's making my F statistic too good. So I gotta get rid of one. Most students would say I would keep the variable that has the highest T statistic and the highest correlation with the dependent variable. That's not true. In the real world, what you do is you keep the variable in the model that's been cited the most in the literature and has basically built the theory around it. Okay. So that's the application. All right. Internal validity, people around you, you work with them, they get input into the modeling process, they bought into your forecast. After you're done, you back tested it, forward tested, it works, you make the recommendation, the company decides and moves forward on your recommendation, and if you're right, that's it, you win. Okay. Unsystematic and systematic risk. Unsystematic risk, I can diversify away. Okay. It's company specific or sector specific risk. I can diversify that away by putting either product lines or creating a product mix by product line within my company where the cash flows have low, no, or negative correlation. So I can diversify that away. I can put stocks and bonds in my portfolio whose returns have low, no, or negative correlation with each other. I can diversify the unsystematic risk. The systematic risk I can't diversify away is political risk, economic risk, recessions, market risk if the stock market corrects. I can't hedge off or have any influence over war in the Middle East or other macro factors. I cannot diversify away systematic risk. Okay. We all know about assets and liabilities. They have to equal. to each other, and then just play with those to create financial ratios. Corporate income statement, same thing, you guys will be building, cash flow statements or pro formas, everybody's gonna be doing that. If you don't know how to do that, you're gonna put yourself at a disadvantage within the firm, okay? Because you're gonna be doing your own budgets, and if you do a marketing or an advertising campaign, they're gonna wanna see the projected cash flows based off the, netted off the costs, and they're gonna wanna know their return on investment, or else they ain't gonna do it. Or somebody else is telling you to do that stuff. And you wanna be the person in control of your budget and your cash flows. And then the cash flow statements. Return on equity is the #1 factor that all investors want to know. Return on equity. Secondarily, return on assets. They do want to know debt to equity and debt to total market cap, because that tells you the amount of leverage that the firm is using to lever up the return on equity. You have the price to earnings ratio, the price of the stock divided by the earnings per share. You have the earnings per share. If I can forecast the price to earnings ratio and the earnings per share for the company and multiply them together, I can determine the intrinsic value of the share. If it's higher than the current stock price, I'll buy it. If it's equal, I hold it. If it's lower, then I sell it. This is a game. Business is a game of rules and metrics. If you learn the rules and the metrics, you become extremely successful. Okay? You just gotta learn it. Weighted average cost of capital and the capital loss pricing model will be used as expected returns or discount rates that we will use to discount cash flows, to come up with present values, net present values, and internal rates of return to make investment decisions. Okay? That's the heart and soul of the class. Okay? And then the perpetuity model, Gordon growth, multiple, and DCF are the 4 intrinsic valuation methodologies used to value stocks and companies. Company level, I'm an investment banker, and I'm a private equity firm. At the security level, I'm an equity analyst, or a portfolio manager, or an investor. Okay. All right, so how much time do I have?
40 minutes.
Perfect, so let's keep going. Anybody have any questions? And as you read the book, all of this is going to become even clearer. As you review some of your old stuff, it's going to become clearer. Yes, sir.
So for the accounting page for the balance sheet, cash flow, and income statement, do you want us just to show?
It's gonna be the line items.
Okay.
Yeah, I just want to know that you know that the balance sheet is basically broken up into short, medium, and long-term assets and liabilities.
Okay.
And that the long-term liabilities are long-term bonds and owner's equity, retained earnings, those things. Okay.
Actually, just one thing for
Yes.
the 4 intrinsic valuation methods. Basically, so the 4 things below are those 4 methods, not you have to find 4 those 4 things.
No, well, did I say give examples?
You said like show 4 intrinsic valuation methods for the following, so it sounds like one find 4 things for each.
No, just one, just the four.
Okay.
So the perpetuity is pretty easy. Perpetuity is just the, you can use the dividend divided by the expected return is going to give you the value of the stock. You know, the Gordon growth is the dividend, expected return minus the growth rate is the value of the stock. The multiple approach is going to be the earnings per share times the PE multiple. Price to earnings per share, gives you the value of the stock. And then the last is the discounted cash flow. 2 periods, 1.11, 1.1. I'm expecting a 10% rate of return. I got dividend 1, dividend 2, plus the stock price, which I'm gonna sell it for at the end of the second year. Discount this back, I'm gonna get a present value of the stock, and I'll go through that a little bit later. It's in the book, you can look it up. So instead of like coming across this stuff as you're studying, I'm front loading it to the front of the class to get you to more comfortable with it, so that as we move through, you're not hearing it for the first time, you're hearing it for the second, third, fourth, maybe fifth time. Okay? You don't learn this stuff, really anything, by going through it one time. You gotta go through it like 5 times or 15 times or 50 times before you really get a solid grasp of it, so that you can explain it to somebody, or you can have conversations with people at their level when they're having these conversations. Okay, that's what I'm really trying to do for you, is to train you in the language, in the science of finance, and really not only teach you finance, teach you how to learn finance. That's really the key. Do you know how to learn? Because they're going to ask you to do stuff. They're not going to have time to teach you. You're going to have to go out and learn it on your own and then come back and apply it. So 40 minutes. When building a forecast model, what are the first steps or questions that need to be taken? Your boss comes to you and says, we need to be able to forecast sales for the next 8 quarters. What's the first thing that comes out of your mouth? What's the first thing you do? This is real life application here. We need you to forecast sales for the next 8 quarters. What do you say? What's the first thing that comes out of your mouth? First thing. Will you build us a forecast model?
Yes.
Yes. Okay, what's the second thing that comes out of your mouth?
Independent variable.
Something different.
What?
Independent variable.
Yeah, what variables do you think drive sales over the next 8 quarters? That would be a really good one too. What's the third question you would ask? Really important.
By when?
Exactly. When do you need it? If they say tomorrow, then you're gonna have to start asking for resources, right? So a week from now, you're still gonna need resources. So when do you need it? And then you get back into your milestone dates. What's the last question? Major question. Is it free? In business, when you do stuff, everything's free.
What are you paying me for? Or
What?
How much are you paying me, I guess, would be.
Well, there's nothing, go ahead. Go ahead.
Like, when you said like publish, like any of this.
Well, not that. Would building a forecast model be considered a project? Would it be, okay, are projects for free? No, would it,
What's your budget?
exactly.
Right.
How much?
Not-
How much,
that
what's
was
my
wrong.
budget?
That was my.
If we don't have the data, how much can we buy the data for? I've been working on a project for 2 years, real life, 2 years been working on the project. These guys were all gun ho. They come back to me the other day and they say, well, you know, we're having a problem getting the data. I said, well, how much is the data? $280,000. They thought it was gonna be 150, got double. Are they happy? Could it kill the deal? Could. I mean, they're gonna make millions, but now they have to double budget. Okay, to get the data, to build the model, to get the forecasts, to basically get the recommendations, get the money in, to make profit. Okay, real life scenario. So those are the things that are important. Okay, how do you determine the dependent and independent variable? They're gonna tell you, or are you gonna make the recommendation? The independent variable, you're gonna ask people internal, external to the firm if you can, and you can do the research in the library with peer-reviewed journal articles, industry research that are gonna guide you on the theory and the literature of what the independent variables have been consistently over time in predicting that dependent variable. How do you test model variable and model significant? You can use the T statistic for the independent variables, you can use the F statistic for the model, and you can use the adjusted R-square. I know there's a lot of others, but those are the key. If you were experiencing multicollinearity in your model, and if you had 2 variables that were highly correlated to the dependent variable and correlated to themselves, how would you decide which one to keep and which one to throw out? You would keep the one that's been cited the most in the literature, not the one that gives you the highest T or correlation, but the one that's been cited over and over again in multiple research consistently over time. That one needs to be in there. Okay? What is internal and external validity? Internal validity is when everybody internal to the firm has bought off on your model. You back tested it, forward tested it, and it works. Okay? And you can make the presentation to the board, and they'll buy it. External validity is the peer-reviewed journal articles. Okay? The external research that validates your model and your variables. And they're gonna ask you, okay? In the, when you get grilled in front of the board, when they start asking you, how did you build the models, and how did you come to the conclusion, how did you do the research, where did you get the data, who were you working with, all of that stuff, you gotta be able to answer all those questions. And if you can answer all those questions, you win, you get it. Okay, you win. All right, so here's the thing, the next section of the exam is on unorthodox monetary policy. Okay, now the book had one little inkling, in the, what was it, chapter 2, where they talked about yield curves and talked about monetary policy. They didn't say anything in that chapter. Okay? If anything, they totally misrepresented the economic environment in which we exist currently. Now, we have to put the economic environment in which we exist currently before we move forward in the finance class. We gotta put it in the environmental context of the macroeconomic environment in which we exist. And the demarcation of the economic environment was set off by the financial crisis, okay? We had a huge run-up, asset price bubbles in stocks and real estate in the 2008, 2009 period, or 2006 and 7 period, that then crashed and burned into the worst recession ever in basically US and global history. And it cost the globe about $30 trillion and cost us 10 trillion on the fiscal side and 5 trillion on the monetary side, so 15 trillion. Never been done before, okay? So currently the Fed's balance sheet, which is the first question, is how big is it? Now the Fed got its balance sheet up to around 5 trillion, okay, at the peak of the crisis. And they've been whittling it down to about 4.3 trillion. Well, that's just a number, but if you put it into a historical context, that leading up to 2007, the balance sheet used to be around 500 to 800 billion. And if you go back to 1970 or 1950, it ran around 250 billion. So it went from 250 billion to basically 500 billion to 4.3 trillion. They printed that money to keep the system from collapsing, and it runs on the banks and us to going into a depression. So this is totally unorthodox monetary policy. And they'll be selling off this balance sheet at about 90 billion a month by the end of next year. And that's a lot of paper to absorb in the market, so there's going to be high volatility in the stock and the bond market by the end of next year. So this just puts it into a context, okay, of the size of the balance sheet. And the balance sheet also equals the reserves that banks have on the balance sheet. So the size of the balance sheet is 4.3 trillion. The amount of reserves the banks hold in the Federal Reserve is 4.3 trillion. It's an identity, okay? So it's a test question. What was the balance sheet prior to 2007? 500 to 800 billion. And the Fed would just hold these bonds on the balance sheet. The Federal Reserve would hold these bonds on their balance sheet. And then what they would do is they would buy and sell these bonds, these treasury securities, to regulate bond prices, to drive interest rates up and down, to cool or stimulate the economy through open market operations, conducted through the Federal Reserve out of New York. Okay. Now we're getting to some of the reality of the situation. What has been the growth rate in the money supply since 2007? So once we went into the financial crisis, the Fed started printing all this money and growing the money supply at about 30 to 40%. Okay? 30 to 40%, which is historical highs. It's never been done before. To buy up the bonds, drive up bond prices, drive down interest rates, to basically make borrowing cheap for consumers and businesses so it would stimulate the economy through consumption and investment. But the growth rate in the money supply since 2007, by 2013, between 11 and 15, around 13, it's slowed to 8 to 10%. And currently the money supply and actually the monetary base has not only slowed, the money supply growth rate has slowed significantly, but actually the monetary base has started to contract, okay? Now, stock prices and real estate prices are highly correlated to the monetary base and to money supply growth rates. So if the monetary base is shrinking and the money supply growth rates, either using M1 or M2, are slowing significantly, what does that tell you about the prospects for real estate prices and stock prices in the near future? Are they going to continue to go straight up, or could they start to come down? Probably, if they're highly correlated, and if the monetary base is going to shrink over the next 24 to 36 months, then you would think at some point it would flow through to the stock market and the real estate market. And it's already flowed through to the real estate market. The lower end of the real estate market, prices are now starting to fall. Because people are more sensitive to rising interest rates at the lower end of the market, and they just don't have the money as the upper end of the market those people are rich, they're not affected. The ones at the bottom get affected the most. Okay. So then the next question is, has the Fed hit gross domestic product, unemployment, and inflation targets? Well, let's see. We went back last class, and in the last quarter, GDP rose at an annualized rate of 4.2%. The long run average, the long run potential growth rate, and the target for GDP growth rate for the Fed is 3%. Did the Fed hit? Has the Fed hit and or exceeded its target? Yes. Got it. The unemployment rate currently is 3.9%. The Fed's target is 5%. Did the Fed hit or exceed the target?
No.
The unemployment rate is below where they targeted. It's 5%.
Okay,
Now it's 3%. Did they hit and exceed it?
yeah.
Yep, they did. Got it. The Consumer Price Index, the measure of inflation, and the GDP deflator is also a target for the Fed. The Fed is targeting a 2% Consumer Price Index or a GDP deflator. The CPI index has just come out. It's at 2.4%. The GDP deflator has just come out. It's at 2%. Did the Fed hit its target? Yes. So if the Fed is hitting its targets and exceeding its targets, what's the probability of rising interest rates? Higher or lower? If they're exceeding and hitting their targets, what?
High.
Higher. And if interest rates go up, what happens to bond prices? They go down. If interest rates go up too fast, too far, what happens to stock prices? They go down. If interest rates go up too fast, too far, what happens to real estate prices? They go down. Okay. So that's basically the directional impact of it. If we were to fall into a recession, would the Fed use negative interest rate policy? Yes. Janet Yellen, before she left the Fed, basically told the banks to stress test their balance sheets under a negative interest rate environment. We've never gone negative. Europe did and Japan did, but we never did. We went to zero. But she said, before I leave, I want you to stress test the balance sheets, and I want you to run your balance sheets, stress test it off a negative interest rate environment. Because interest rates are so low right now, if we fall into a recession, the only option for us is to drive interest rates negative. Unorthodox monetary policy. Right. So what does that tell you? If interest rates are driven negative, this is where they were at zero. This was the yield curve, maturity of the bonds, interest rates. This is where we were. Zero interest rate bound. Then recently the yield curve is starting to shift up. Okay, so interest rates are starting to move up. They're still extremely lower than they would be if we didn't have this unorthodox over-accommodative monetary policy. So interest rates now are significantly lower than where they should be historically, okay? Which is actually causing the stock market and the real estate market to continue to appreciate, because interest rates are lower than they otherwise should be at this point in the business cycle. But if the Fed prints more money on top of the 4.3 trillion, buys up more bonds, drives up bond prices, and drives interest rates negative, who benefits from it? Who benefits from negative interest rate policy? So what would be the impact on the economy? Well, if they drive interest rates negative, then the cost of capital to borrow by individuals and companies gets lowered significantly. So now it's cheaper to borrow for consumption or investment purposes. So it could stimulate the economy unless we fall into a liquidity trap. Okay, read your Keynes. What about asset prices? What would negative interest rates do to asset prices? Well, we can use just the perpetuity model, which is the coupon. You take the coupon interest rate, multiply it by the principal of the bond, you get the dollar amount of the coupon. So this is my dollar amount. And I'm going to divide it by the interest rate to get the value of the bond. Or I can take the dividends in dollar amount that I'm going to get from the stocks, divided by the expected return to get the value of the stocks. So it's a simple valuation model. So if the Fed drives interest rates negative, What's it gonna do to interest rates and expected returns? Is it gonna cause them to go up or down? Down. And if the interest rates and the expected returns go down, what happens to stock and bond prices? They go up. So by going to a negative interest rate policy will prop up bond prices and stock prices. Okay, so who benefits? Who's gonna benefit?
Investor?
Investors, exactly. So basically, it props up asset prices, and investors are gonna benefit the most. What about savers? Do you think in Europe, when I was getting a negative interest rate on a 10-year bond, or buying a Japanese bond in Japan at a negative interest rate, I'm an investor, I'm a saver, I'm in retirement, I need to buy these bonds to live off the income, but the interest income is negative, okay, am I better off or worse off? If I'm getting negative interest, I'm basically giving the government more than I should to just have liquidity, and I'm willing to sacrifice liquidity for earned income on my investments. I'm getting negative return. Am I happy? No. Am I sad? Yeah, the Japanese actually went freaking nuts, okay, because they're uber savers, okay, and they're getting negative interest on their bonds, which basically means that they're getting less in the future than what they put into the bond, and their standards of living and social welfare are deteriorating. You're looking at a worse social outcome because of it. So savers are getting hurt. Investors will benefit, and what about businesses? Will they benefit from very low costs of capital? Yeah, because they did. They basically borrowed in the bond market for a very low cost of capital, and they bought back their shares and caused their stock prices to go up and inflate. They were able to borrow very cheaply in the bond market and invest in automation to replace humans for machines, or machines for humans. So they were able to do that too. And then they were able to take the excess money that they made, barring any major recession, and take that money and invest in plant and equipment or global supply chain expansions and product development. Okay, how am I doing on time?
20 minutes.
Perfect. Right on time. So the next one is the yield curve dynamics. Okay, yield curve dynamics. All debt, all equity securities, all bonds, all stocks, all real estate are priced off of the yield curve. So if I'm ever going to issue a bond or issue a stock or buy a piece of real estate, I'm going to price it off of the yield curve, because the yield curve is the base interest rate, the risk-free rate. It's the yield on government, U.S. government treasury securities. Okay, it's the base rate. It's a risk-free rate. Okay, and the yield curve is by interest rates, or yield to maturity, by the maturity of the bond. Okay, so I have 3-month, 6-month, 9-month bonds, 1-year, 3-year, 5-year, 7-year bonds, 10-year, 20-year, 30-year maturity bonds. And there's an interest rate associated with each maturity for each bond. Okay, and it's risk-free because theoretically it states that the U.S. government can never default on its bonds, because the Federal Reserve will always be there to print more money to pay the coupon interest rates and pay the principal back on the bonds. I know it sounds like a shell game or a kind of a Ponzi scheme, but it's basically the theory in which we exist in here, in our in our finance theory. So there is the yield curve. In most cases, the yield curve is upward sloping. Why is it upward sloping? Well, it's upward sloping based off of the Fisher equation, okay? Based on the Fisher equation. And the Fisher equation basically states that nominal interest rates for each maturity, for each bond, is a combination of the real interest rate plus inflation expectations. Not inflation, but inflation expectations. So the real rate is basically the base rate. In an environment of zero inflation, this is the real rate, this is the rate that I want, okay? But I'm a lender, you're all lenders, right? You're gonna be lending the government, lending corporations money when you buy their bonds. You're gonna wanna be compensated for lending them money. not only are you gonna wanna be compensated for just the base rate based on supply and demand for capital in the market, but you're also gonna wanna be compensated for the deterioration and the erosion of your purchasing power due to inflation. So I want inflation compensation, okay? So I want the real rate plus the inflation rate as my rate of return to get me to lend to you. So the curve is upward sloping because of those inflation expectations. And when inflation expectations fall, the curve is gonna flatten, and in the worst case scenario, it's gonna invert, predicting a recession, and I'll get in that in a minute. So if the market thinks that inflation is gonna go up, then nominal interest rates, risk-free rates, are also gonna go up. And if the inflation expectations are uniform across the yield curve, the whole curve is gonna shift up. And we know that if the curve shifts up, then bond prices are gonna go down. And if inflation expectations start to fall, then nominal interest rates will fall. And if the falling inflation expectations are uniform across the curve, then the yield curve will shift down, interest rates will fall, and bond prices will go up. So the yield curves can shift up and down based on inflation expectations. Real rates of return move up and down cyclically and secularly. They do not move up and down on a daily basis. So the majority of movements in interest rates are due to changes in inflation expectations on a daily, minute by minute, second by second basis. Okay. All right. So what else does it say here? Okay, rates of motion up and down, shifts the yield curve up and down, and flattens and inverts the curve. Show the equation and graphical representation for a normal upward sloping curve. That's what that is. A flat and inverted curve. So over here, I have this, and this needs to be in your exam. Right? So this is an upward sloping curve. You want to write out the Fisher equation, and you want to show me that inflation expectations under an upward sloping curve are positive. That under a flat curve, using the Fisher equation, inflation expectations are zero. It's a flat curve. And in an inverted curve scenario, the inflation expectations are negative and the curve is inverted. Over the last 24 months, the Fed has been selling off its bonds. Wage inflation and commodity inflation have been increasing. And with the trade war currently in the process, that's going to add tariffs, which is going to increase consumer prices on goods, which is also going to push up inflation. So the Fed has started to sell off the bonds, started to flatten the curve, and the yield curve is actually inverted using swaps, which is another instrument. And in the emerging markets currently, as of today, or the last 2 weeks to 3 weeks, the emerging market bond markets have started to invert, basically predicting a recession. Okay, and I'll get into that in a second. What are the 3 yield curve theories? There's really 4 of them actually. One is the expectations hypothesis, which is the Fisher equation. It basically states that the yield curve shifts up and down and flattens and inverts, and moves around based on inflation expectations. And that's the expectations hypothesis. Then there are 3 other theories: the market segmentation, liquidity preference, and preferred habitat. And those theories basically state that the yield curve is a segmented market. Marketing majors, but there's market segmentation. The market is segmented by short-term securities, medium-term securities, and long-term securities. People will borrow and lend in these segments depending on their preferences or their preferred habitats. Businesses mainly borrow and lend on the short end of the curve because they're dealing with inventories and inventory turnover. Corporations will also participate in the medium-term market because they need to finance equipment, and equipment normally lasts for about 5 years. So you're going to use 5-year bonds to finance the acquisition of your equipment purchases, along with the 5 years depreciation allowance there, matching the economic life of the physical life of the asset. And then the long-term segment or long end of the term structure, or long end of the curve, is dominated by pension funds and corporations too. Corporations will issue 10 to 30-year bonds, mostly 10-year bonds, to finance plants, real estate, construction, real estate acquisitions, because it's a very long life. And pension funds and endowments will also purchase 10 to 30-year bonds because they have pensioners that are going to be retiring, and they're going to start claiming on their defined benefit programs in 10 to 20, 30 years from now. And they want to make sure that the bonds are maturing exactly at the same time that they've actuarially predicted when the liabilities are going to hit. So they can match the asset lives with the liability lives, which is really the key at the end of the day. So different segments of the market prefer different segments along the yield curve. Okay, and those are the three theories. What do movements and shifts in the yield curve have on asset prices? Well, we already said that. If it shifts up, interest rates shift up and values go down. If it shifts down, interest rates go down and values go up. Okay? And that's mainly for bonds. For stocks, it's a little bit different. If interest rates go up, but the growth rate in my dividends go up faster, then that's going to prop up my stock price. Worst case scenario is you have basically higher interest rates and falling dividends growth, and your stock prices are going to crash. So this is recession, this is high interest rates, the worst combination. Okay. So get familiar playing with those bonds. How does the Federal Reserve influence interest rates? Well, the Federal Reserve influences interest rates on the short end of the curve because they conduct open market operations, monetary policy, buying and selling short-term securities. Okay? So the Federal Reserve directly impacts short-term security prices, bond prices, and interest rates, and indirectly the medium and the long term. Okay? Directly short-term, medium term, indirectly medium and long term, and they conduct open market operations to buy and sell the bonds, driving bond prices up and down, to regulate the economy, to stimulate the economy. Okay. And that's why you see the curve going like this, it flaps like this as the Fed manipulates interest rates to cool or stimulate the economy. We talked about it, how do they influence interest rates through open market operations. And open market operations is the tool. How am I doing on time? What is the objective of buying and selling bonds? Well, the objective is they buy bonds, they drive up bond prices, and they drive down interest rates, and they stimulate the economy. If they sell bonds, bond prices go down, interest rates go up, and they cool the economy. So the Federal Reserve buys and sells bonds in the open market operations to drive bond prices up and down, interest rates up and down, to cool or stimulate the economy. Okay. So you want to kind of memorize this language, okay? Because I've perfected this language over the years. Okay? Does the Fed control and influence directly short-term or long-term interest rates? Short-term directly, long-term indirectly, but they do influence both. Okay? And then what I'll do is next class, what I'll do is probably after the presentations, we'll go up to the stockcharts.com dynamic yield curve. I already have the video in there. It's one of the very first links in the syllabus. And I will show you that what happens is, once the yield curve inverts, the yield curve's already flat. Okay? But the swap side is already inverted. And emerging market debt is already inverted. So we've already seen it. And the curve is so flat that there really is not much difference between long-term interest rates and short-term interest rates. They're called a quarter of a percentage point is 25 basis points. 1 percentage point is 100 basis points. So the difference between the long-term interest rates and the short-term interest rates is only 25 basis points. The Fed has already said they're going to raise interest rates at least 3 to 4 times by the end of next year. So the next time they raise the rates, the curve is going to be flat. The next time they raise the rate, it's going to be inverted. Once the curve inverts, based on what I'm going to show you next week, once the yield curve inverts by at least 50 to 150 basis points, it's kind of the normal. Once it inverts, the stock market peaks in less than 12 months. And we are in a recession in less than 24. I can go back to 1974, I can go back to 55, I can go back to 1935, I can go back at least 80 to 100 years. And the yield curve has been the #1 predictor of not only stock market peaks, but also recessions. Now you can, after this point, once we get through kind of yield curve dynamics, we can start moving into some other aspects. That's really the foundational aspects for this firm, for this course, okay? Because if you don't talk about this stuff, I don't know how you're studying basically finance and valuation within a vacuum, in a bubble. And that's the application, maybe that's academics, but I don't teach academics. I teach application, okay? So unless you have any questions or anything, I'm gonna end it there. Okay, and then on Thursday, you guys are ready to go? Okay, awesome. Look forward to the presentations, and we'll keep going on that. Chapters, yeah, we're gonna go.
You have this thing live.
We're gonna figure 20 minutes each.
You know, I'm just curious, are you able to keep up with him? Because I'm definitely having a little trouble keeping up with what he's saying.
I'm only going on prior knowledge that I have. I don't, beyond that, I don't know really what you're saying.
Alright, so it's not just me then. Yeah. I'm getting some of it, but it's just like, there's a lot of information.
Yeah, the stations are already, yeah, I've already supposed to be Excel. Because I didn't want you to be frustrated doing it. And then teach us. Yeah, so what I'm trying to do is keep on everybody to see how they're doing, and then give them more time.
He's right though. It will occur in the next 3 years. If it doesn't, then it breaks every single year. That's not possible. Probably 2020. I won't graduate.
Oh, no, that's not the solution.
Late 2018.
No, that's, you're in a, that's the statistical, that's not what
Yeah, I know. If you have like a sum of money, just wait till the market closes in the recession, buy back in, and then roll this year and afford it.
Expected return, it's just a resource. And there's some other resources that I provided to you. This was more applications. So it's just another resource. Yeah.
I want to ask you,
Yeah.
You don't have to. You might stop by.
Growth rate and dividends. So if this goes up, this goes down, that goes up, and that goes up.
Yeah.
This goes up more than this, that's gonna go up. This goes down, that goes up. This goes up, that goes up, that goes up, that goes up.
You ain't got nothing.
If the I goes up, these go down. I goes down.
You took that? I'm like, I can't right now. I was like, I feel like it's good. And it was like, yeah, because I don't. I'm not gonna buy law.
And then when I told her it was 6'9", she's like,
This goes up.
Oh, I need to.
it's always like. You could tell he's texting it. Too pinky was. No way. Hell no.
This goes down, this goes down. Price to
It
earnings.
does suck.
It's the price to stock divided by the earnings per share is the PE multiple. If that goes up, that stays constant, that goes up. That goes down, that stays constant. Because this is on the so it's just, it's memorized, and then burning it. Should just go back. Okay. Tomorrow, I'll be yeah. It's gonna be here. Cool. Good luck for it.
Dr. Susan?
Yes, sir.
Is finance club tomorrow? I'm interested in joining it.
Tomorrow, 1 o'clock, either here or next door.
Okay. Could I come to it?
Yeah, absolutely.
Alright,
Totally.
cool.
Yeah, and you should sign up for this, try to take this exam if you can.
Oh, yeah, that looks interesting. When do?
You can start at any time, it's $119 total. And if you study it and you pass it, then you can go to AXA, Wells, or BMA, or wherever you want to go. Your life.
Yeah, I might think about that.
Yeah, it's
So
almost
it definitely will
guaranteed.
help with.
Guaranteed internship. And then the chapters are really small.
Yeah.
So you can tear them up and then just study for it.
Dinosaur.
And then go just take these exams and see how you do. And then just study, test.
You can take it as many times as you want.
You got one shot.
Oh, you do
And
it?
then after you failed it, then you gotta sign up again, pay it again. to
Oh,
take
I
it
got
back.
you. I got you. Can I grab a blue book as well?
Yeah.
I never really wanted to ask you, but now I kind of work here.
It's okay. Once you take your time. And I'll clean up the class.
Alright, have a nice rest of your day.
Great, thanks,
Dr.
guys.
Susan.
Appreciate
You know,
it.
I can't help but worry that I'm not getting this stuff as fast as I should be.
That's okay, I speak real fast.
Uh,
Don't worry about it.
all right, Jess. This is terrifying.
Because I'm gonna go